Well, thank you for joining us again on the FinCEN Report podcast. My name is Jonathan Wilson. I'm one of the co-founders of the FinCEN Report company, and thank you so much for joining us. I wanted to talk about today the difference between the two different rulemakings that FinCEN has underway and how they are relevant to business owners and lawyers who deal with FinCEN. I'm sure everybody saw the final report that FinCEN issued last fall, at the end of September, which is the final report on the beneficial ownership rules. Those rules are, of course, the ones that govern who has to file under the Corporate Transparency Act, when beneficial ownership reports are due, and all the details that go to beneficial ownership reporting. More recently, in the early part of 2023, FinCEN has issued an advanced notice of public rulemaking, what they call an ANPRM, and that has to do with the access rule. In other words, after FinCEN collects all of this information from the beneficial owners, how are they going to store that data? Who are they going to make it available to? It's that more recent notice of proposed rulemaking, the ANPRM, that has come out and has created a little bit of confusion. So the September rule has to do with beneficial ownership reporting. The access rule has to do with getting access to the information. Now, there are some very interesting things in the proposed access rule that people should pay attention to. In particular, FinCEN is telling us that they're going to give access to the information to different types of entities with different levels of success. The Treasury Department, the IRS, are going to have access to the information all the time for any legal purpose. It's going to be their data. Other government agencies are also going to have access to the data with a relatively low threshold of need. If FBI or ATF or DEA want the data, they can do it with almost no showing of necessity. Banks are going to have access to the information if their customer gives them permission. Now, as you can rightly imagine, most banks are probably going to modify their customer documents so that it becomes a condition of doing business with the bank that the customer gives the bank permission to pull their data from the FinCEN database. So in reality, the data that you give your bank on their KYC form is inevitably going to get matched up against the data you give to the government as part of your FinCEN beneficial ownership report. Banks are going to see to it that the two are the same. There are also rules for access to be given to foreign law enforcement. There is a heightened standard of requirement there, but even any level of foreign government access ought to be a concern to some folks. So I expect that there will be a fair amount of reporting and a fair amount of commentary on that aspect of the rule. The access rule is still open for comment, but not for very much longer. And we will have to wait and see what FinCEN does with the comments they receive on their pending access rule. So that's the access rule, the beneficial ownership rule. Today, I'm going to be joined by my special guest, Matthew Erskine. Matthew is a trust and estates lawyer from Worcester, Massachusetts. He's been in practice for several decades and has a deep experience involving trusts and estates and some of the unique aspects those entities have as it relates to the Corporate Transparency Act. So stay tuned for our interview with Matthew Erskine. So Matthew, welcome to the show. Thank you for joining us today.
Thank you for inviting me.
You bet. Now you're based in Worcester, Massachusetts. Do I have that right?
I am based in Worcester, Massachusetts. My family's practiced trust and estates law since the 1870s, but I'm the 10th generation of my family that's lived in Worcester, so we're newcomers to the legal profession.
10 generations. That is quite amazing. I think you're telling me your family in that area went back to the 1600s?
1645, courtesy of a one-way ticket from Oliver Cromwell during the English Civil War.
Wow. Well, when I start my historical podcast, we're definitely going to have to come back and revisit that story. But we're stuck talking about FinCEN and things like that.
My father turned 99 last August, and he still comes into the office about once a week. So
for the benefit of our audience, tell us a little bit about what your practice is. What's your area of focus?
Well, we're a trust and estates firm. We do planning and execution of estate plans for individuals, and we concentrate on people who have businesses, art collections, legacy real estate, all of the sort of unique assets that no other estate planning attorney wants to deal with. And we have acted as private fiduciaries on occasion. And we've handled as many as 7 generations of the same family in the same business.
What is a private fiduciary?
Private fiduciary is usually an individual, but it can also be a private trust company or a limited purpose trust company. Generally, it's not a institutional trust company like a bank or a publicly traded trust company. Something which you have more flexibility with as far as who you decide to have do what in your trusts.
So with that focus on trusts and estates and private fiduciary work, how do you see the Corporate Transparency Act affecting your practice and your clients?
I see it as the single largest impact on trust and estate planning, basically since I would say the year 2000, when they completely redid the federal estate tax law. The reason is because in a lot of different types of estate planning, you're attempting to discount the value of an asset. And one of the ways of doing that is to put your real estate, your art collection, whatever, into an entity, usually a family limited partnership or a family limited liability company. And the idea is that you then can give fractional shares of whatever it is that you want to your various and sundry relations and discount that value because it's a fractional share rather than a whole, it's a 1/10 of your Picasso rather than the whole Picasso. All of those entities, which everybody assumed were never going to show up on anybody's radar screen because it has no income, are now going to be reportable. The act is specifically designed, at least from my perspective, to capture all of those sort of holding companies, no matter how small. It's going to capture small operating companies. It's going to capture large holding companies. And all of a sudden, all of these entities that every estate planner has created are now going to have to be reported. And I don't think the clients are going to be happy about it.
Yeah, I can imagine if you were, a high net worth individual and you'd set up this family limited partnership to, as you say, share pieces of your Picasso, you never expected that you were going to have to file some document with the government disclosing the name and driver's license of everybody involved.
It's sort of like potato chips. Nobody ever just has one, right? There are always dozens of these entities. And I suspect that before the 1st of January of next year, there are going to be a whole slew of these things that everyone's going to take a look at and say, this is not worth doing. We're consolidating them, we're dissolving them, we're converting them into something else.
One of the interesting features of the Corporate Transparency Act is that it all begins and ends with the definition of reporting company. And reporting company is defined in the law as an entity that is formed by the filing of a document with the Secretary of State. And you and I were talking about some of the different types of entities that exist that, outside of the usual corporations and LLCs that people might not even think about.
Specifically, what it does not cover are trusts, general partnerships, and in that case, what I'm calling a general partnership is an informal general partnership. Here in Massachusetts, you can create a general partnership basically with a handshake. Also here in Massachusetts, there's something which is known as a Massachusetts Business Trust, which is an old variety of quasi corporate entity. And it dates back to the time when it used to be that the only way you could create a corporation was to actually get an act of the legislature to create the corporation. And this goes all the way back to the 16th century with the formation of the English East India Company, which was literally an act of parliament to get it to be created. So if you look at the statute, it says you must file the document that creates the trust, which now means that because the Corporate Transparency Act says it only applies to entities that are created by filing a document with Secretary of State or an equivalent organization. That means that by its terms, those entities are not going to be required to report. Trustees that are controlling more than 25% of the ownership of an entity must report, and they must report the beneficial owners of those trusts if those entities are a reporting company, unless you are a regulated trust company, right? So as a trustee, which means that, going back to the private trust company and the limited purpose trust company, I think that for anyone that's got a large, complex estate plan, they're going to take a long, hard look at whether or not it's worth it to create a private trust company for their family.
So an awful lot of legal work for the lawyers who do what you do.
I
Corporate Transparency
think it should be renamed as the Trust and Estates Lawyers Perpetual Employment Act. Because, I've talked to a couple of accountants who would be the other people I would think of that would be doing this thing. They don't want to touch this with a 10-foot battle axe because it has nothing to do with tax returns. And all you're doing is acquiring liability. But as a trust and estates attorney, I'm usually the one who's actually creating and filing the paperwork for creating a limited liability company or a corporation. So I'm going to have to report anyway because I'm one of the people who's, covered by the statute. So in for a penny, in for a pound, as they say. There are so many things that are not well defined in this act. It's unbelievable. Under a lot of trusts, you give people what's called a power of appointment, which says either during your lifetime or at your death, you can assign assets either generally or to like your descendants. So you say, yes, my wife has the right to say, I want the company to go differently than what my husband set up because things have changed. That would then mean that the wife, even though she might not actually be a owner of 25% of the company, is now going to be a reported person by the trust because she has the right to dispose of the assets. Seems like, how many angels dance on the head of a pin, but I look at what the IRS has done on the FBAR, the Foreign Bank Account Reporting Act, which is broadly similar to this. And they are now very aggressively enforcing the penalties on that. So there's a case that was actually argued before the Supreme Court recently, Biltner, I think is the name. The guy had 5 bank accounts in Switzerland. He didn't report them for 5 years. They said, where are the reports? And he said, oh, I'm sorry, here are the reports. By the way, here's $50,000 for the $10,000 per report that I didn't file. And the IRS said, no. It is $10,000 per account per year. So please, $2.72 million. Thank you very much. And I'm just looking at it and saying, wow. I have a hard enough time getting clients to file their annual reports. Getting them to do these changes, I don't know how we're going to do it. The biggest issue that I see is that people don't realize that they've got to do this. We're not necessarily getting the information and making people aware. I know that your firm does the reporting side of it, but what we're looking at is creating something where you can send it and it's a series of questions that gives you enough idea to say, yeah, you need to call this client and find out what's going on. Not confidential information per se, but to say, yes, I have a company, and yes, it is a corporation, and yes, it is smaller than 20 employees and $5 million worth of net revenues. And then you can call up and say, well, we need to get together and figure out what's going on. The other thing is that if you're going to be putting assets into a trust, then you really need to take a look at the terms of that trust to see if you have to comply with this. And because trusts are infinitely flexible, you can't tell, there's no generic trust. There's, infinite variations on the trust. You have to take a look at it and say, well, yes, here you have a provision that says that you have to report it, but this person over here doesn't have to report it.
So I guess for every trust that's out there, it ought to talk to someone like you to see to what extent they're going to be required to report under the Corporate Transparency Act.
At the risk of being completely self-promoting, yes, unfortunately, you're going to have to take a look at all those things that you did 15 years ago that has been sitting on a shelf and you haven't looked at. You're going to have to dust it off and you're going to have to take a look at it, because if you don't do that reporting, it's maximum of $10,000 fine and up to 2 years of jail, which is a pretty steep amount.
Well, words for the wise, Matthew. Thank you very much.
A pleasure, by the way.
Thank you.